Hi everybody, welcome back to the 10th of an Hour with Griffin Bridgers. For today's episode, episode 105, we're going to talk about present interest gifts of entity interests. Now, when I talk about entity interests here, what I'm really angling at are entities that are created within a family or within a group of family members for ownership purposes, and that are usually created primarily for estate planning purposes and not for the conduct of an active business. So we'll get into kind of the nuance and difference there in a minute. But for the time being, as always, this presentation is not intended to substitute for legal or tax advice and is provided for educational purposes only. Now, why do we care about this? Well, every individual has a per donee gift tax annual exclusion of $15,000. That means every individual can give away up to $15,000 to any number of donees or recipients without paying any gift tax or using any gift tax applicable credit amount against that potential gift tax. And as we're going to look at in a few minutes, that also takes away the gift tax filing requirement potentially. But this exclusion does not apply to all gifts. It only applies to gifts of present interests. So what is a present interest? Generally, what it's going to be is an unrestricted right to the immediate use, possession, or enjoyment of property. And it's because of that definition that many gifts in trust that are completed gifts will be treated as gifts of future interest for gift tax purposes. So for that reason, you generally cannot use the gift tax annual exclusion for gifts to an irrevocable trust unless the trust meets an exception to Code Section 2503, or unless the beneficiary who you're counting as a donee for purposes of that gift tax annual exclusion is given a crummy withdrawal right. Crummy withdrawal rights are their own headache that we can talk about another time, but for the time being I want to shift us away from trusts and look more at gifts and entities such as family partnerships. I briefly introduced those a minute ago, but could it be possible that the restrictions that are inherent under state law and just customary types of provisions in a partnership or entity arrangement would keep a gift of an interest in that entity from being a present interest gift? Now, before we get into how the IRS has viewed that and how the tax court has viewed that, it's important to kind of consider the characteristics of the family partnership when we're digging into this issue a little bit more. It's often the case that family partnerships are designed to create a better overall economic arrangement than fractional ownership of family assets. And what the family might do is have everybody pool their resources together into a family partnership so that there is one owner of each asset, the partnership, instead of fractional ownership amongst family members who could disagree. Because with this, there's a consolidation potentially of power in maybe one or two key family members who manage this partnership. But by giving up that level of control, what the partners are also doing is giving up the benefits that would otherwise be attributable to fractional ownership. In particular, what they're doing is they're giving up unrestricted rights to the immediate receipt of the income of the property, the unrestricted right to sell the property, the unrestricted right to immediately receive the sales proceeds of the property, and the unrestricted right to get the property back out of the partnership itself. Now, three of these are really rights that are attributable to the property itself, and the fourth is a problem that's inherent in the partnership arrangement typically. Now, given these, I mentioned unrestricted right because recall that I mentioned on this slide that the unrestricted right is a core component of the present interest. Now, how does this intersect with the present interest rules when we're looking at a family partnership? Now, back about 9-10 years ago, a little more, there were some tax court opinions such as Hackle, Price, and Fisher, where the IRS prevailed in an argument that gifts of interest in family entities may not be present interest gifts. Now, a lot of the IRS arguments in those cases rests on some key characteristics of a family partnership, which showed that there is no unrestricted right of a partner who receives an interest by gift 2, the immediate possession, use, or enjoyment of the economic benefits that go along with that partnership interest. Now, some key things that would cause restrictions to those rights include: 1, the manager might be the person who approves distribution of cash on a discretionary basis. So that takes away the immediate right to receive the profits of the partnership. 2, there might be buy-sell agreements, rights of first refusal, restrictions on the transfer of an interest or a sale of an interest to a third party. But what the IRS seems to be more hung up on here is that with a lot of rights of first refusal, that's not restricting the sale. The partner could still sell the partnership interest internally, but the IRS is more hung up on the time delay in closing the sale, because a lot of rights of first refusal might give an option period of 30 days for other partners to purchase the interest, and then maybe a closing period if they fail to exercise their purchase option, either close a sale to an outside third party, or if they do accept the option, to close a sale internally to one of the partners. So because of that long runway, what the IRS is saying is that there's no immediate right to enjoy the proceeds of that partnership interest. And then next, another issue is that there is no right to the immediate return of the capital account. Now, a better way to state this is that there's no way to just instantly cash out or redeem your partnership interest and get back your fractional share of the partnership assets. So, key takeaways here. 1, I've observed many practitioners who just ignore this risk, and that's not necessarily done out of negligence or ignorance. It's more because, as I mentioned earlier, you typically don't have to file a gift tax return for present interest gifts that use the annual exclusion. The only real reason you might do so is that if you have a spotty valuation, if you're claiming a discount or whatever, you might want the 3-year statute of limitations to run on the gift tax return so that the IRS is bound by the valuation reported on that gift tax return. You might not file the gift tax return if that's not an issue, if it seems like you have a pretty easily determined book value. But if there's a gift of a future interest, as I mentioned earlier, you have to file a gift tax return. So if the IRS is going to start arguing or continue arguing that present interest gifts do not qualify in an entity context, you might open yourself up or your estate up to penalties if there's a return not filed. Now, that's its own separate discussion, but for the time being, if you're really shocked by this and worried about this, I want to bring things home, and I haven't seen anybody bring up this point. What I'm kind of putting together is 2 key points, and maybe the IRS looks at this differently when you're looking at the donor versus the donee. But on the donor side, what the IRS has been arguing a lot more in the recent years is less, is this a present interest, and more, does this gift of an interest cause the donor to have some sort of retained interest in the partnership property, especially the property represented by interests that have been gifted away. And what the IRS has been doing in that is that they've been ignoring the restrictions that are inherent in the partnership agreement in order to make their arguments under Code Section 2036 or under the proposed regulations under Code Section 2704, which are currently dead but could come back in the future. But if the IRS is carrying out this theme of ignoring partnership level restrictions when analyzing gift and estate tax issues, could that argument also go the other way if this present interest argument comes up? Because a core component to that, in ignoring those restrictions, is that the IRS assumes that family members would all act in concert to the greatest extent possible to access partnership property. So if that's the case, if there's a presumption that the family members would act in concert to dissolve the entity or to elect a favorable manager that would immediately distribute all profits to the family members, then the IRS is kind of bound by a separate argument to have to honor gifts of entity interests as being gifts of present interests. Now, that hasn't really come to into light yet in any sort of argument I've seen, but I think it's something that if you are a taxpayer or you are representing a taxpayer, it's something to keep in mind for the future. As always, if you have questions or topic suggestions, you can email those to me at griffin.bridgers@gmail.com. Thank you for listening to this episode of the 10th of an Hour, and I look forward to seeing you in the next one.